Ever wonder how a bank, which pays you 0.01% interest, can afford that huge skyscraper downtown? That disconnect is what we're solving today. We're pulling back the curtain on the how do banks make money business model so you can stop being a passive customer and start playing the financial game smarter. By the end, you'll move from confused about banking mechanics to having a clear, structured roadmap for optimizing your entire relationship with them. Let's dive in. Before we can master the rules of the game, we need a simple definition. At its core, the bank is a financial intermediary, or what I like to call the economy's matchmaker. You deposit your extra cash, and the bank acts as the central reservoir or hub, which takes cash from people who have extra and lends it to people who need it. This critical role creates liquidity and facilitates massive economic activity. What does that mean for you? It means the bank manages the inherent risk of lending for the entire system. It's this centralized risk management that individual people can't easily do. It's this intermediation that allows them to make their money. But how do they turn that simple process into massive profits? That brings us to the core mechanics. We know banks are the economy's matchmakers. Now, let's get into the engine that turns that simple idea into billions in profit. There are three key mechanics. The most basic way a bank makes money is by mastering the spread. Think of the bank as a toll booth operator on a bridge. They pay you a low interest rate on your deposits and savings. This is their cost of borrowing money from you. Then they charge a much higher interest rate when they lend that same money out for loans and mortgages. The difference between the high rate they charge and the low rate they pay is what they keep. This spread is precisely what's called the net interest margin, or NIM. This is the fundamental measure of their profitability on traditional lending. To show you the profit floor they consistently aim for on their assets, historical data reveals the average net interest margin for U.S. banks has reliably hovered around 3.8% since 1984. That's where the skyscraper comes from, taking a small margin and applying it to trillions of dollars in assets. But how do they take that single dollar you deposit and make a 3.8% margin on more than $1? The answer is a mind-bending concept called fractional reserve banking. Here's the massive concept you need to grasp. The bank doesn't keep all of your deposit in a vault waiting for you to come back. Instead, they only keep a small fraction of it on reserve. The vast majority of the rest of your money is immediately loaned out. Now, follow the magic. When the bank loans out that money, the borrower uses it, say, to buy a car. The car dealer then deposits that money into their bank. The second bank keeps a small fraction and loans out the rest, creating a chain reaction of deposits and lending. This is how the banking system effectively creates new money through a chain reaction. This maximizes their NIM. This system is actually the global standard and has been used before central banks existed because bankers realized not all depositors will demand payment at the exact same moment. This relies heavily on regulation and central bank oversight, like the Federal Reserve, to ensure stability. While lending is the core engine, modern banks have built a vast array of secondary revenue streams, known as non-interest income. This is money generated from services other than the traditional interest rate spread. We're talking about all those common, annoying fees. Examples include fees for overdrafts, using an out-of-network ATM, wire transfers, and sometimes even routine monthly maintenance. For the biggest players, this also includes lucrative investment banking services. From the bank's perspective, these fees are nearly pure profit. They require little capital to generate, and crucially, they act as a consistent revenue buffer. This buffer protects their overall profitability against fluctuations in the volatile lending market. This means you're not just a passive source of deposits, you're a source of fee-based revenue, which is why optimizing your relationship is so critical. Understanding the bank's playbook, like net interest margin, fractional reserve banking, and non-interest income, is only half the battle.
The goal now is to apply that knowledge so you can stop being the passive customer who fuels their profits and start using their mechanics for your own advantage. The bank's business model relies on a fundamental trade-off that you make every day. The biggest benefit of a traditional physical bank is undeniable: convenience, security, and access. This includes easy access to ATMs, the ability to walk into local branches for service, and the security provided by FDIC insurance. These features are valuable. The cost you pay for that convenience is accepting near zero interest on your checking accounts and savings accounts. Why do they do this? Because they capitalize on your immediate daily need for easy access. They know you need that cash available instantly, and they exploit the time it takes you to move it. This model is being challenged, however. The rise of high-yield savings accounts at online banks offer a powerful comparison. These online-only institutions offer much higher interest rates, giving you better yield with slightly less, though still adequate, access. A high-yield account is simply a savings account that pays you much more because the online bank has lower overhead costs, which they pass on to you. Knowing this trade-off is the first step to making a conscious choice about where you keep your emergency fund. Now, let's look at the financial missteps that cost customers the most. The most common and most expensive mistake you can make is incurring unnecessary fees. This is how banks generate pure profit, remember? The biggest culprits are overdraft fees, charges for not meeting minimum balance requirements, and excessive use of foreign ATMs. Being penalized for a negative balance or an empty account is pure profit for the bank. Mistake number 2 is leaving large cash reserves in a standard checking account. You might think you're being safe, but where inflation is running even moderately high, that money's value is rapidly eroded its value over time. It's a guaranteed loss every year just to keep it easily accessible. The smart move, the truly optimized strategy, is to set up automated tools to regularly sweep excess cash out of that low-interest checking account into higher earning accounts or investments regularly. You keep a small buffer in checking for bills, and everything else works harder for you. This is where we turn the tables. Now that you know their revenue streams, you can build a personal strategy that makes you a profitable customer for yourself, not the bank. You've earned the right to optimize your wealth by understanding their system. Your core strategy should be dual-focused. First, minimize what you pay the bank, fees, loan interest rate. And second, maximize what you earned from the bank, interest on savings and credit card rewards. To minimize, ruthlessly avoid all fees and negotiate for the lowest possible loan interest rate when you borrow. To maximize, leverage the bank's need for your capital. Use free checking and high-yield savings accounts to get the security of the banking system without giving them free use of your money. Finally, completely change how you view credit cards. View them not as tools of long-term debt, but as short-term, interest-free loans and reward generators. If you pay the full balance every single month, you get the rewards, the benefits, and the interest-free short-term access to capital, while the bank profits from the merchant fees, not your interest payments. You came here looking confused about those big bank buildings, and now you leave with the knowledge to play the banking game on your own terms. You have a clear path to save more and build wealth faster by minimizing what you pay and maximizing what you earn. If this deep dive clarified the complex world of finance for you and moved you closer to building your financial roadmap, please show us by hitting the like button. And don't stop here. Subscribe to the channel so you don't miss the next vital step in your structured curriculum. Let me know in the comments below, what's the first financial fee you're going to eliminate? You are now a smarter customer, and that's how wealth begins.